Welcome to your final financial stop, where today we're going to be talking about inflation. What is it? How does it affect your wallet and the things you pay for? Before we get started, I want to ask you to subscribe or share this video if you liked or learned anything from the content. Subscribe to my Patreon if you want to learn how to beat inflation. And follow me on Twitter and ask me any questions that you might have. First, you have to understand what inflation is, and it's a general level of prices for products or services that rise, decreasing the purchasing power of a country's currency. Since 1776, the highest inflation rate was recorded around 30%. We've seen that happen 4 more times. The Fed's job is to use policy and intervene with currency, debt, and the markets to manage inflation and monetary flow. Today's U.S. inflation is about 7%, which is the highest since the summer of 1982. The inflation spike we expect to see today, tomorrow, or next year might be due to the pandemic's induced supply chain issues, rising energy costs, labor shortages, and increasing the demand even after 2020's problems. There are a few things that measure inflation, primarily the Consumer Price Index, or the CPI. This is the change in price of consumer goods and services based on a basket of products. This basket of products is typically about 80,000 items spread out all over the nation, averaging down to what the normal household has. The Employment Cost Index measures the change of labor cost. Producer Price Index measures the average change in price of domestically produced goods. GDP Deflator measures price movement of goods and services in the GDP. The GDP is the total amount of goods and services in the economy. These measures have to do with housing, food, recreation, transport, appliances and utilities, health, and much more. The only downside is health makes up about 17% of the entire economy, whereas the CPI only accounts for about 6% of it. So the ratios weigh differently amongst their groups, introducing problems that could raise or decrease inflation rates. The causes of inflation could lead to multiple sources, including the increase in wages, increase in price of raw materials, increase in taxes, decline in productivity, and increase in money supply. These causes typically raise the price of everyday commodities and goods. These causes can be broken down internally and externally, meaning a surge in property prices, or higher oil, or higher inflation of other countries, or the rise in domestic business taxes. They can be further broken down into cost push, which is the production cost rising and producers pass increase to customers, or demand pull, where demand for goods increases and exceeds production capacity. So whether supply is shortened or demand is increased and they cannot maintain one another, inflation typically occurs. Hyperinflation is inflation at a very high rate, typically about 50% per month. Venezuela's annual inflation rate almost hit 3,000% in 2020. Relaxing their economic control allowed for foreign currency to regulate a little bit more, therefore easing its tension. The best way to avoid it at this point, if your country isn't already too deep in inflation, is to increase interest rates to slow down the economy. Inflation can be a good thing. Slowly increasing prices helps keep businesses profitable and prevents customers from waiting for lower prices. It keeps the money going. Deflation is the decline in prices for goods and services. It's bad for borrowers who are paying money that isn't worth what it was when it was loaned. It's worse when you find out that these interest loans are at an all-time low and trap others. The pace of technological improvements and increased productivity, as well as decreasing the supply of money, can all lead to deflation. So what's next for 2022? We likely won't see a decline in inflation anytime soon. And food, energy, and used cars have been increasing faster than ever. However, we might see a drawback to that. With a decrease in demand in goods and balancing out supply, or an increase in services demanded, may bring inflation rates back down. So if we get more people in the workforce, or we demand less, we might return back to normalcy. There are a few tips and tricks that you can take home with you. A company who can raise their prices with the higher inflation rates keeps their profit on the higher production cost. So large retailers and ETFs that diversify your portfolio are some of the best investments you can take part in. Tips or treasury inflation protected securities move your principal value with the inflation rate so you never lose its worth. Series 1 bonds change their interest rate, not your principal's value. So depending on how you like to invest, this could be a good route to go. And make sure you always negotiate lower prices with your streaming services, insurance premiums, cable and cell phone plans, and gym memberships. Asking for more can work too, such as buying a car does your dealership offer free oil changes. Now please be aware that certificates of deposit with an interest of 1% may be good until the annual rate of inflation is 3%. Losing over 2% in value with taxes included. Inflation could hurt or help some certain equities and stocks. If the company has a lot of debt, inflation rises, they're even more in debt. and vice versa. S&P 500 is said to return 8% per year after inflation by diversifying its portfolio amongst the top 500 companies out there. Cryptocurrency is said to combat inflation best. It's relatively scarce, and it acts as a medium of exchange for currency as well as data. It's safe, it's secure, and it's available for everybody to look at. And with that being said, inflation affects people differently. For those who are living in poverty, inflation can mean not affording the essentials such as food and water. Inflation for those in a higher class may mean less vacations. Whether you stay home all day or you travel the world. Thank you for joining me here today. Subscribe to my Patreon and find out how to beat inflation and use this information to increase your portfolio's worth. Follow my Twitter and ask me any questions. I'd be happy to reply. And don't forget to share or subscribe if you liked or learned anything from this video. Thanks for joining. A quick reminder that this is not financial advice, and any information found on this website should not be substituted for information coming from a professional financial advisor. Understand that every investment has its risk and its own rewards, so please do your own research, stay safe, and have fun. I'm not responsible for any information that I do or do not provide, but this is what works for me and how I do it.